According to Denis Healey, the former Labour Party Chancellor of the Exchequer, the first law of holes was, and I quote, "When you're in one, stop digging." Interestingly, this message is one that some mining companies appear to be taking to heart. FTSE 100 firm Glencore, for example, has announced it is to cut annual zinc production by a third at mines in Australia and Peru, and reduce production of copper at mines in Zambia and the Democratic Republic of Congo. Glencore shares have responded, bouncing rapidly from the autumn lows that were reached amid a panic over whether low commodity prices meant the firm could sustain its enormous debt pile. Now, subsequent plans to raise fresh equity, cut the dividends, sell assets and reduce its liabilities are now supporting the shares. But the key question is whether the rally in Glencore, and for that matter the wider mining sector, is here to stay. Hello, I'm Russ Mould, and in this week's edition of Breaking the Mould, I'm going to look at the mining sector, the key issues which face it, and what stock market history may be able to tell us about how it could perform in the years ahead. Now, first of all, let's look at the bull case for mining equities and the mining sector overall. First, miners are slashing capital investments, cutting costs and preserving cash, all good signs of an industry adapting to a harsher new reality. Second, there are some very fat dividend yields on offer, assuming of course analyst forecasts for 2016 can be relied upon. Anglo American and BHP Billiton offer dividend yields north of 7%, Rio Tinto won more than 5%. This graphic here shows the FTSE 100's 8 miners and their forecast dividend yields for next year based on consensus. Third, the stocks are bombed. 5 of the 10 worst performers in the FTSE 100 on a 5-year view are miners, as this chart shows. Rio, Fresnillo, BHP Billiton, Antofagasta and Taylor & Charlie, right at the end, Anglo American down by some 80%. Now, the bear case. First, commodity prices are still weak. Aluminium's just hit a 6-year low, Dr. Copper's looking pretty peaky, and even diamond prices are now on the slide as demand wobbles. In a low growth, low inflation environment, commodities could still find the going tough. Second, those dividend yields cannot be taken for granted. Glencore's already cut its payments, others might follow. As a junior analyst at an investment bank, I was always taught that any yield that was more than 1.5 times the 10-year gilt yield could prove too good to be true. Now that may make me an old fogey, as the 10-year gilt yield of just 1.8% means any equity dividend yield over 2.7 needs scrutiny. But if you think I'm past it, still please keep a check on earnings cover anyway, because that's pretty thin. Just look at the chart here for details. You really want to see 2 as the bare minimum to get some comfort. This also may explain why just 2 of the 10 best performing UK equity income funds over the last 5 years have a mining stock in their top 10 holdings. And on both occasions they've got Rio. Third, several of these stocks combine operational gearing, big percentage changes in profits related to a £1 change in sales, and financial gearing, lots of debt. This means earnings and share prices could well be volatile in the future. Now, whether you think the miners are right for you or not will ultimately come down to 3 things. Your view on the economy. If you think a strong inflationary recovery is coming, that's a scenario that historically has favoured commodities and miners. If you think deflation is the next step, you may be more wary. Second, your view on central banks. If you think more QE is coming, this is a scenario that could favour real stuff, like commodities and miners over paper-based asset classes like cash and bonds. If you think deflation is coming, you may be inclined to stick to fixed income and cash, again looking at historical performance. And also, it'll depend on your view on how safe those dividend yields are, as they really are a key prop for miners' share prices. Just one closing thought. Miners were all the rage 5 to 10 years ago, when many investors were buying into the idea of a super cycle that would be stronger for longer. Unfortunately, that hyped valuations up to what proved to be unsustainable levels, persuaded company bosses to binge on acquisitions, and encouraged companies to overinvest in fresh production capacity. Classic stuff. The quicker management teams atone for these sins and effectively stop digging, to again quote Mr. Healey, the better. This can take time. Think back to when the technology, media and telecoms bubble soared in 1998 to 2000 and then collapsed horribly. Here, in case you weren't there or if you've just forgotten or blocked it out, is that X certificate chart for the software and hardware sectors. Now the next graphic looks at the aftermath of that. Note that even after the tech indices had halved, there were 5 failed bear trap rallies. each one progressively less powerful, each one eventually losing more ground than it gained. It took 9 years to finally squeeze any optimism out of tech stocks. Miners peaked in 2008, nearly 9 years ago, as this final chart shows. So let's see if history repeats itself, even if, as we all know, the past is no guarantee for the future. Thank you for watching, and I look forward to seeing you next time.